Hello there everyone, it's Nat here and you're officially tapped into another episode of Kingfo Finance. Today we're going to be discussing a trap that you should avoid if you're thinking about purchasing a home for your own personal use, or if you're deciding to purchase a home to start your real estate investing journey. Now, if you guys haven't been keeping up with the news, it's important to note that mortgage applications have been dropping substantially. So as the mortgage applications have been dropping, you see that the price of homes have been increasing steadily over the last year. Now, in certain areas, it seems like the market is starting to correct itself, but generally speaking, prices are still much higher than they were in previous years. So from last year to this year, it appears that home sales have decreased 16%. Prices have increased 19.6%. This has led the United States to having an average home value of $450,000 in 2022. As opposed to in 2020, when the average cost of a home was only $329,000. That's over $100,000 price difference. So this is what puts a lot of people in a friction point. They don't know whether they should purchase a home now, wait, and then purchase it later. Everyone's confused. Every different expert you talk to is giving you their own 2 cents, but there's no hard set answer to this question. So we're going to take a minute and analyze every potential option you could exercise and see which one would give you the best outcome in search of a home. So the first option that I hear from a lot of people is they need to buy a home now in order to avoid prices potentially increasing to where they won't be able to afford a home in the future. Another option is people want to wait until the housing market crashes so they can go ahead and purchase a home and hopefully purchase that home at a discount because prices are a lot lower. The third is people are going to go out and go get an adjustable rate mortgage, which will give them an initial interest rate that is a lot lower than the current interest rate we see in the market today. And they're doing this in hopes of avoiding the current high interest rates. And before you can go about a specific approach, I think it's important to weigh your actual options and try to determine why exactly are you purchasing this home to begin with. There are also certain costs that come with the home that you need to be able to sit down and analyze and ask yourself, are you able to actually afford these costs? The first cost is, are you able to afford the down payment required? Second, with your expenses all escrowed together, could you afford the monthly payments? And third, which a lot of people forget about, can you afford the cost of actually moving from your current home and into your new home? What I don't want you to do is put yourself in the trap that a lot of people tend to fall into. And that is thinking, oh, my home is my biggest investment. So remember this and remember this clearly. Your primary residence is not an investment. Your primary residence is not an investment. Repeat after me now. Your primary residence is not an investment. As a matter of fact, comment below. Your primary residence is not an investment. And the reason why I say this is because when people typically believe that their home is an investment, they tend to overextend themselves. And what comes with buying a home that you initially can't afford because you're overreaching is now you're going to buy upgraded furniture, upgraded costs of basic necessities that you typically use, and now you're find yourself in a situation where you can't meet those monthly payments and you end up going into foreclosure. So my advice when it comes to buying a home is buy the right home at the right price at the right time for you. Stop trying to time the market. Stop worrying about what's going on with the interest rates or the cost of homes. Buy the property that you can afford and it's the right fit for you and your family. And the best way to do this is by understanding what your end goal really is. If your end goal is to go out and make money, then yes, you would be considering what's going on in the market because you're looking to buy an investment which you could rent out. However, if your end goal is to find somewhere to rest your head at night, then none of those market factors should matter to you. So let's use an example to explain this concept. Look at how it was to buy a home previously and what it's like to buy a home now, and the trap that a lot of home buyers are currently falling into that you should avoid. So a house that was worth $500,000 back in 2021 is now worth $600K in 2022. Now let's take a look at how the market has changed between 2021 and 2022 and see what kind of costs and benefits there are to buying a home then as opposed to buying a home now. So if you were using a conventional loan in 2021 for a house that's worth $500,000, you put 20% down, that would be $100,000. And you could expect to have an interest rate of about 2.5%, which means that your monthly payment on this home would be $1,600 a month. Now, in 2022, you can expect a home that used to be worth $500,000 to be worth $600,000. And if you were to put 20% down, this would be $120,000 for your down payment. This means that you're going to be financing a lot more. You can also expect an interest rate of about 5.5%. This means on the same type of home, you're going to be paying $2,700 a month. This is over $1,000 more on the same exact property, and this doesn't even factor in the property tax and the difference between that. Banks are very aware of this, and they realize that it deters a lot of people from actually wanting to purchase a home, and that's when they decide to swoop in behind and pull a little finesse. They start advertising the adjustable rate mortgage, which a lot of people fall victim to. Now, if you're not aware, the adjustable rate mortgage is what led to a lot of the foreclosures during 2008. As a matter of fact, people like Dave Ramsey have fallen victim to these type of mortgage setups, and that's why now they're just completely against debt all in all. But let's look at how the adjustable mortgage rate would work in this kind of environment today. So in 2022, we take that same house that's now valued at $600,000. You still need to put the 20% down, so that's $120K. But instead of having a 5.5% interest rate for the life of the loan, now they'll offer you something like, hey, we'll give you a 3.7% interest rate for the first 5 years of the loan. And of course, as a customer, you think you're getting a great deal because you're not paying a high interest rate as you would on one of the more conventional loan methods. However, after the first 5 years, this mortgage rate is going to readjust. So basically, you're gambling on the fact that after 5 years, the loan or the interest rate on that loan will be a lot lower than what you currently have. So with a 3.7% interest rate, you're looking at a monthly payment of $2,200 as opposed to a $2,700 monthly payment with the 5.5% interest rate. So what happens is when you take the gamble by taking a 3.7% interest rate by getting the adjustable rate mortgage, you have no idea what's going to happen after that 5-year mark. So the only reason why you should even consider this offer from a bank is if you know without a doubt, like without any uncertainty, that you can pay this mortgage off within that 5 years. And if you know that there's some small chance or percentage that you can't pay it off within the 5 years, then there's no reason why you should even try to assume that risk to begin with. Therefore, your best option is to go ahead and take that regular interest rate of 5.5%. And what happens when you do that is, even though your interest rate is currently higher, you factored in that, hey, this is for my personal investment. It's somewhere I'm going to rest my head every day, and I can afford these monthly payments, and there's no guessing involved in it. However, if the market so happens to change and the interest rates do go down, what you can do is you can refinance your loan into a loan with a much lower interest rate. So instead of rolling the dice and taking a gamble with the adjustable rate mortgage, you find a home and all the criteria meet your standard and what you can afford through month to month, and stick with that property. And then by some chance, if the mortgage or interest rate decides to decrease, you can refinance it to a better deal for yourself and save some additional money. The fact of the matter is, no one can guess the future and no one knows what's going to happen, regardless of if you're an expert or just a neighborhood block boy. The guessing game is a losing game. The best method to follow is by looking at your budget and actually determining what you can and cannot afford. The goal is that you should want to live in a home that you can afford. And it's important to remember, as I said very early in this video, that your primary residence is not what's going to make you rich. That's all I got for you guys today. Make sure to like, subscribe, and leave a comment, and I'll see you all next week. Peace.